Welcome to my channel. I'm Scott, and in this video I'm going to walk you through a process of valuing ARM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 118 billion market cap. They're trading at $115 a share, and they have 1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Lots of free cash flow in 2021, over 1 billion. Then 1/3 of that in 2022, 380 million. It almost doubled in 2023 to 646 million, up a little in the trailing 12 months to 760 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's about 400 million in 2021, $500 million in 2022 and 2023, but a really small positive in the trailing 12 months, only 85 million. They must have had lots of write-downs that year. Revenue is the sales for the company, and that goes up a little bit each year from 2 billion to 3 billion. It grew a lot in 2022, 33%, but it dropped from 2022 to 2023. It fell 1%, up 10% in the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 50 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $41 billion. We divide that by 1 billion shares. And we get a calculated stock price of 40 bucks. They're trading at 115, so they're trading at a 186% premium. It's a whopping sell according to the model. So this stock seems really overvalued. But you need to know the stock price is not based on their future free cash flows. Maybe in the long term, but in the short term, anything can happen. Stocks can be really volatile. This stock could double or triple in the next year or two. But the only way it can stay at those levels if they start generating enough revenue and profits to sustain those numbers. Right now it does seem overvalued, but the market is not looking towards the past, it's looking towards the future. Even though I project their future free cash flows to be 2.7 billion by 2027, which is 4 times the trailing 12-month number, it still seems really overvalued. There are 62 companies in the same industry as ARM, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 144 million in capex. Taiwan spends the most, 35 billion. Because they're a foundry, they do the manufacturing for the big companies like Nvidia. This company is debt-free, so they have a 0 debt to equity ratio. They don't pay a dividend. They generate 760 million of free cash flow, a little less than the average. They rank 8th in market cap. They're a decent sized company. 100 billion market cap is nothing to sneeze at. But look at Nvidia, 1.8 trillion. It's just crazy. When I was in high school, I used to look at stocks. And the main thing I did was look at how big they were, the market cap and what they were trading at. And I thought to myself, will there ever be a company at 1 trillion market cap? I think Exxon was the largest at like 300 billion. And now there's companies north of 3 trillion or around 3 trillion, Microsoft and Apple. And this company is closing in on 2 trillion. And according to their price multiples, they seem really overvalued. Price to book is stock price over book value per share. Investors are paying $23 for $1 book value. PE is stock price over earnings per share. Investors are paying $1,400 for $1 of earnings. Price to free cash flow is stock price over free cash flow per share. Investors are paying $155 for $1 free cash flow. And price of sales is stock price over sales per share. Investors are paying $40 for $1 of revenue. They generate 3 billion of revenue, a lot less than number 9, 10, and 11 on this list. Also less than 12, 13, and 14. which is why they have the worst price to sales ratio out of anybody on this list. Even worse than Nvidia. So if you think Nvidia is overvalued, they're not nearly as overvalued as ARM in terms of price to sales. And the reason ARM may have a big future, it may be a 300, 400 billion market cap company, is because they're still small, 118 billion. Small relative to these top three companies. Their 5-year annual revenue growth rate is 10%. Nvidia is number one at 29%. Amazing. But Nvidia doesn't have the most revenue. Taiwan Semiconductor does. And Nvidia is even less than Intel. Let's take a look at their most recent presentation. This report was published recently on 2/7. Their fiscal year ends 3/31. So this is their third quarter of 2024. Their fourth quarter of 2024 is 3/31/2024. So this is the data through 12/31/2023, which is their third quarter 2024. Revenue of $824 million, up 14%. That's comparing to the third quarter of 2023, or October 1st, 2023 through 12/31/2023. Free cash flow for the trailing 12 months is $724 million, up 63%. They shipped 7.7 billion chips. The $824 million of revenue for the quarter, about 60% is royalty revenue and the rest license revenue. Non-GAAP gross profit, $800 million. Non-GAAP operating cost, $459 million. So their non-GAAP operating income, $338 million. That gives them operating margins of 41%, really high margins. And they convert 30% of their revenue into cash. So 30% of the $824 million is converted to cash. $251 million of cash. Non-GAAP means they strip out things like stock-based compensation and other one-time items. This quarter, the $824 million of revenue is their highest ever. Their highest royalty revenue ever, $470 million. The highest before that was $442 million in Q2 2023. And for license revenue, $354 million. That's their second highest. Last quarter, $388 million. Here's a breakdown of the royalty revenue, the $470 million, their highest ever. You can see it was low in Q4 2023, $374 million, and it's grown $100 million since then. Their RPO, remaining performance obligation, is highest than ever, $2.4 billion. That's 50% higher than 2 quarters ago. Remaining performance obligation is revenue that will be recognized in future periods. So it's in the pipeline. It's getting close to being recognized. They're also lowering expenses. R&D in Q4 2022 was $336 million. It's down to $280 million. SG&A is also low. It was $315 million a couple years ago. It's half that at $157 million. Actually, almost exactly half. And COGS, cost of goods sold, is pretty steady in the low to mid 20s. It was highest in Q4 2022 at $37 million. But it looks like they're getting much more efficient. They're lowering their COGS quite a bit. Look how high their gross profit margin is. 94%. It's currently almost 97%. They're extremely profitable. And their operating margins were negative 5% 2 years ago in Q4 2022. Then it got up to 40% the following quarter. Q4 2023, negative 0.2%. Now it's 44%. It was highest last quarter at 48%. That means in this quarter, they convert 44% of their revenue into operating profit, which are just amazing margins. Here are the chips that were shipped by quarter. 7.7 billion this quarter. It peaked at 7.9 billion 1 year ago, the third quarter of 2023. And here's their forecast. For Q4, it's 875 million. For full year 2024, it's 3.2 billion. Fourth quarter EPS, 30 cents. full year EPS 122. You can see how much they evolved since 2016. In 2016, 3/4 of their business was mobile. Now it's about 45% of their business. And they added auto, cloud, IoT, Internet of Things, and consumer electronics. So they're much more diversified. And they're really trying to get into AI space. That's why the stock has been blowing up lately. They have really solid relationships with Android and Apple. And they've been making big waves to get into the SoFi space. That's scalable open architecture for embedded edge. Some are saying this is the future for the auto industry. It's connecting cloud computing with auto. You can see they're working with Microsoft in their cloud computing area. Microsoft Azure is like 20% of the cloud computing market. Amazon is 1/3 of the cloud computing market with AWS, Amazon Web Services. If this company can provide the semiconductor chips to those two companies, this company can 3, 4, 5x in the next year or two. NVIDIA was really trying hard to acquire this company. They offered $40 billion, but it never got regulatory approval, so the deal fell through. I'm sure they're kicking themselves now because the company's worth a lot more than $40 billion today. Look how much their royalty revenue has grown. ARM was $50 million in 2014. Now it's up to $100 million in 2023. It's half the market share, and it's only going to get bigger. And the beauty of royalty revenue, it's ongoing. It's in perpetuity, as long as the products are viable and being used. Let's take a look at their financial statements. You can go to the company's website. They provide their financials in Excel format. The columns in white are their quarterly numbers, and the columns in blue are their annual numbers. And they show the prior 8 quarters. So in the first quarter of 2022, revenue $657 million. In the fourth quarter of 2023, revenue of $824 million. So revenue goes up pretty much each quarter. So revenue is on an uptrend, going up overall. Below their revenue is the cost of revenue. So they're really, really good margins. Let's calculate the margins. So their gross profit margin is in the mid 90%. Really, really profitable. Almost unheard of. Their operating income is positive each quarter except the first quarter of 2023 and the third quarter of 2023. Oh, also the first quarter of 2022. And they do have positive net income every quarter except first quarter of 2022 and third quarter of 2023. Their net margins range a lot. Their best net margin is in the second quarter of 2022, 33%. Their current net margin is 11%. On an annual basis, they do have positive net income each year. Let's look at the balance sheet. This is their current assets, and this is their current liabilities. Let's calculate their current ratio. So their current ratio is pretty high. It's at least a 2. So they can easily cover their current liabilities with their current assets. So this should give you comfort the company can pay their current debts with their current assets. They do have a decent amount of cash, $600 million up to $850 million. Their accounts receivables have gone down. It was $1.1 billion, peaked at $1.3 billion. Now it's $800 million. When a company has low accounts receivables, that could be that credit terms are too tight. If they have high accounts receivables, they might have too loose credit terms. Their biggest asset is goodwill. It's about $1.6 billion a year, which is a little less than half their assets. If you go to their Wikipedia page, you can see some of their acquisitions. Their first significant acquisition was in '99, Micrologic Solutions, a software consulting company based in the UK. You can see each year they do a few acquisitions. Treasure Data was a big one, $600 million. That provides enterprise data management software for data-to-data IoT platforms. In November 2015, this company, alongside Cisco, Dell, Intel, Microsoft, and Princeton University, founded the Open Fog Consortium. And that was to promote interests and development in fog computing. You may be thinking to yourself, what the hell is fog computing? is an architecture that uses edge devices to carry out a substantial amount of computation, storage, and communication locally and routed over the internet backbone. You may be like me and you're still not sure what fog computing is. So their total assets go from 6.5 billion to 7.1 billion. Their biggest liability is a non-current portion of contract liabilities. This is when a customer prepays for something according to the terms of a contract. So there's some similarities with unearned revenue, but they have to carry it as a liability on the balance sheet until ARM delivers the product or service. Assets minus liabilities gives you your equity, the value of the company according to the balance sheet, and that's grown from 3.5 billion to 5 billion. Retained earnings shows you how profitable the company is historically, and that's gone up from 2 billion to 2.5 billion. This is the sum of all their prior net incomes. Additional paid-in capital is how much money the company raised from selling their business. They raised 2.1 billion. And accumulated other comprehensive income, AOCI, is unrealized gains or losses. So they have an unrealized gain of 388 million. This is usually due to a hedging contract or a derivative. This row, AOCI, can alert you to possible gains or losses in the future. This number isn't that high. If it was like 10 billion or negative 10 billion, then it would give you an indication of how the future may unfold. Because an unrealized loss or an unrealized gain will result in a realized loss or gain at some time in the future. It's like if you bought $10,000 of a company's stock and that stock is worth $100,000 today, you have a $90,000 unrealized gain. The only way you receive the gain, you report it on your income taxes, is when you sell the stock. So if you do sell the stock in a year and you still have that big gain, then you have to report it on your income taxes and pay taxes on it, assuming the gain doesn't reverse, or the gain can get bigger. Let's look at a statement of cash flows. There's 3 sections: operating, investing, and last is financing. So they do have positive operating cash flow every quarter except the second quarter of 2022 and the second quarter of 2023. Operating cash flow converts net income into cash. So even though they reported an accounting profit of 87 million in the fourth quarter of 2023, they actually generated 310 million of cash flow. Mainly because of stock-based compensation, they pass through a $200 million expense on the income statement, which brings down your net income, but we add it back here. In their investing section, there's not much going on, 21 million of PP&E. This other stuff you could kind of ignore. This is when a company buys short-term investments to collect interest on the cash they have. In the financing section, they added 8 million of intangibles. This is probably through an acquisition. They had a cash outflow of 4 million from other financing activities. And remember that stock-based compensation up here, well, they have to pay taxes on that. They pay 36 million of taxes, so that a cash outflow of 48 million in their financing section. Let's take a look at ARM on Simply Wall Street. Last price 115, 118 billion market cap, up a whopping 62% in the past week. Let's see what they say about the company. ARM architects, develops, and licenses central processing unit products, CPUs, and related technologies for semiconductor companies and OEMs, original equipment manufacturers. It offers microprocessors, systems, intellectual property, graphics processing units, physical IP, and associated systems IPs, software, tools, and other related services. Its products are used in various markets such as automotive, computing infrastructure, consumer technologies, and IoT. They operate in the US, China, Taiwan, South Korea, and internationally. They were founded in 1990, headquartered in the UK. They operate as a subsidiary of Kronos 2. An equity analyst has this price at $19. They say it's 500% overvalued. Here's their historical stock price. It started out around $50. That was in September 2023. And it traded sideways for the next 2 months. Then started going up a little bit. From November to January, it hit 77. Then last week, it hit 73. And then in just one day, it went from 73 to 115. That's the thing. You never know when the stock will pop. You would have had to wait 5 months for this big run-up. That's not a long time. But for a lot of investors, 5 months feels like forever when you're just watching the stock trade sideways or barely go up. And this article explains why the stock jumped so much. On Thursday of last week, the stock increased 60%. Their V9 technology is expected to double royalty payments. They beat analyst forecasts on the top and bottom line. Top line is revenue, top of the income statement. Bottom line is net income, bottom of the income statement. Simply Wall Street says the stock is really overvalued. Their target is $40. Which is just a big coincidence. This is the first time I've seen Simply Wall Street's valuation, and it happens to be almost identical to mine. But that's rarely the case if you watch my videos. 28 analysts priced this stock at $90. Look at their revenue forecast for 2024. $3.1 billion, 2025, $3.9 billion, 2026, $4.7 billion. And their free cash flow estimates for 2024 is $500 million, 2025, $1.25 billion, 2026, $1.8 billion. But even if they do hit these targets, they're still really overvalued. This is the company's debt. It's just a dot because they have no debt. It's always zero. Their equity is pretty healthy. It's up to $5 billion currently, and they have lots of cash on their balance sheet, $2.4 billion, so they're set to explode. They have a solid balance sheet, no debt, they can grow and leverage. 91% of the companies owned by public companies, 8% by institutions, and 2% by the general public. Their big shareholder is Masayoshi Son's giant investment bank, the big Japanese fund. They own 90% of this company. SoftBank bought a big piece of Alibaba before they became public. And they've made so much money on that investment. Tens of billions of dollars. Maybe hundreds of billions of dollars they made on that. GQG, located in the Sunshine State, owns 1.6% of the company. Jennison, located in the Big Apple, owns 0.7%. Fidelity, located in Beantown, with $4.5 trillion of assets under management, owns 0.44%. Alphabet, you may have heard of them. They own a company called Google, owns 0.19% of the company. Gasalo, located in the Constitution State, owns 0.12%, Intel 0.11%, and their employee count is pretty steady, 6,300 in 2022, 6,900 currently, and the ticker trades on the NASDAQ and Deutsche Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.